Hello everyone, welcome once again to our channel TWI. We're very sorry we've been on a little bit of a break for a couple of weeks, leading up to 1 or 2 months, but it's good to tell you that we are back and we are better and we have some very fascinating content to share with you. Today we're going to be looking at something very, very fascinating. We want you to make plenty money, right? That's why this channel was created in the first place. We want you to make money. We want you to be successful financially. And so today we're going to be looking at how you can make millions, how you can build wealth using the stock market. We're going to be looking at how you can make tangible financial returns investing in the stock market. A lot of people believe that investing in the stock market is a very risky venture. When I hear things like that, I laugh a little bit because it shows some measure of ignorance about how the stock market works. Yes, it has been said time and time again. Robert Kiyosaki said that, and even the great sage Warren Buffett said that investments are not risky. It is the investor that is risky. So today we're going to be trying to de-risk investing in the stock market. The word de-risk. We're trying to help you, or we're going to be helping you to minimize the risk you would get entangled with investing in the stock market. If the stock market was that risky, why do a lot of successful people pump tons of money there? You hear people pump retirement savings into the stock market and all of that. If it was such a dead end, why do you watch the news every day and you have a full section on the stock market report and they are telling you the stocks that gained and the stocks that lost value and all of that? It means that there's a lot of money exchanging hands. It means there's a lot of reward being received in those places. And so today we're going to begin a series on how to become very successful investing in the stock market. Okay, so the basic thing about investing in the stock market is to understand fundamentals. The term is fundamentals, understanding of fundamentals. And I'm going to break it down, okay? Like I said, this is a series. We're not going to do everything in this one video, right? We're going to make this as simple as possible. We're going to give an overview, and then we're going to do other videos to give you more detailed explanations of what we're talking about. Fundamentals are basic, qualitative, quantitative. Please forget about the grammar. It looks big, but it's not big. Just trust me, okay? Qualitative, quantitative pieces of information about companies, securities, currencies, and the overall economy, okay? That is what fundamentals are, okay? Qualitative, when we talk about qualitative, it means something you cannot measure, something you cannot put in numbers, okay? But when we say quantitative, it means something that you can measure, like rice that you measure inside mudu, or like water that is 1 liter, 2 liters, stuff like that. Measurable. Quantitative. Qualitative, you cannot measure it. But it's also important too, because it is these two elements you use to determine whether you should invest or should not invest. Is that okay? So when we talk about qualitative information, we are defining fundamentals. Well, qualitative information has to do with the management of the company. Who is managing this company? I want to buy their stocks. I want to buy their shares. Who are the people managing it? Are they black? Are they white? Are they orange? What experiences do they have? How long have they been managing companies in the industry? In one of our videos, we talked about the fact that every company in the stock market operates industry by industry. There are several industries within the stock market. And I'll give you an example. There's a banking industry within the stock market, okay? Bank shares, okay? You have what is called fast-moving consumer goods. You have what is called industrial goods. These are all subsectors within the stock market, all right? So in each company, you're looking at the experience of the people managing the company. I'm talking about qualitative information, right? The people managing the company. You want to know who are the people managing it, all right? So that is qualitative information of the fundamental. Then you talk about the quantitative. So, like I mentioned, quantitative is the one that you can measure. One you can measure. 5 pieces of orange, 10 pieces of pineapple, and all of that measurable. So when we talk about quantitative information, you're dealing with things like profitability. You're dealing with things like revenue, cash flow of the company. You're dealing with things like the liabilities of the company. You're dealing with things like how they are able to combine their debts, that's their liabilities, and how they're able to combine it with their assets. What are the return on equity? These are some technical terms, but don't worry, don't allow the high sounding nature of those words to confuse you. Don't worry, I'm here to break it down for you, because you must make money in the stock market. Are you getting what I'm saying? So it's not a complicated thing, all right? So I'm going to be doing a series on these subject matters. We're going to be talking about how to measure profitability. When we're talking about how to look at liabilities. When we talk about liabilities, the monies that they are owing, or the monies that companies are paying out for expenses, for debt. The truth is that you cannot do business without borrowing money. Most big companies, virtually all the big companies in the world, they borrow money one way or the other. That's why the issue of liability is coming. But we want to be able to tell this company, I want to buy their shares. Do they borrow unnecessarily, or do they borrow with reason? You want to be sure that this company, the monies they are borrowing to do business, right? They are using it for the things they said they are using it for. So that you don't want to buy into a company where the management, they are using your money anyhow. Eventually, when you now buy shares there, all right. So that's why it's important to pay attention to how their liabilities are being utilized. All right. There's what is called debt to equity ratio. We're going to do a video where we explain that one very well. It's a very key fundamental to look at, all right, before you buy stocks of any company. Okay. Now, part of these fundamentals that we are, giving an overview of tonight in this video is what you call macroeconomic and microeconomic fundamentals. When we talk about macroeconomic, we're talking about the things that affect the entire economy. You get what I'm saying? And that one is regulated by the government, because the government is is responsible for what you call fiscal policy. Now, it's the government that fixes fiscal policy. So you hear things about inflation, you hear things about interest rate, you hear things about unemployment. These are all macroeconomic. They are things that affect the general economy. Now, this is important. You'll be wondering, what it concern unemployment, concerning inflation, concerning interest rate. If there is high unemployment, what it means is that people don't have work. And if people don't have work, it means they are not earning money. And if people are not earning money, it means they don't have resources to patronize businesses. So one of the things you are looking at is, if you are looking at the unemployment level in the economy, you are asking yourself, the employment is high, then the particular business I want to buy their shares, are there enough people in the economy to patronize the products or the services that company is offering, right? Because at the end of the day, investing in stocks is all about doing business. The company will do business with the money you invest, right? They will do business and they will make a profit. It is from that profit they have made that they will now give you as dividends. So you need to be sure that people have the resources to patronize that business you want to buy their shares. That one makes sense now. It's very clear, right? So it's key. So when you're talking about macroeconomic factors, it concerns you as an investor, as a prospective investor. You want to tell, if the interest rate is high, what it means is that when that company is going to borrow money, they are borrowing money at a high interest rate. Then you can ask yourself, you can now look at the debt ratios we are going to be discussing subsequently. You can now ask yourself, these people that are managing this company, can they manage this debt with this high interest rate that CBN has now set for the economy. So this is what macroeconomic factors are about. Then you have what is called the microeconomic factors. Those ones are smaller factors, okay? They are also important because they affect smaller parts of the economy. So as we begin to tie up this video, in case you are been seeing our content, you are an existing member of our channel and you have not subscribed, bros, you are not doing us well. Sister, you are not doing us well. You need to hit that subscribe button. You need to like our videos and share it now. It's going to make a lot of sense for you and for people in your circle. So until I see you next time in our next video, don't forget, this is the beginning of this series. So you don't want to miss subsequent videos we are going to be posting. So until I see you next time, thank you for tuning in. Thank you for watching this video. Bye.